In the name of God, the most merciful, the most beneficent. Working capital management. This is CMA Part 2, Strategic Financial Management, under which Chapter B, Corporate Finance, and this is Topic 4 for Working Capital Management. So, in this part of this lecture, the learning outcome is we will be defining working capital and identify its components and calculate the net working capital, explain the benefit of short-term financial forecast in the management of working capital. Let's see this as the overall framework of the working capital management that we are going to study in detail. Basically, it comprises of working capital management and cash management, marketable securities management, accounts receivable management, and inventory management. And we know that this is working capital. It's a strategy for managing current assets, overall current assets. Technically, it is current assets minus current liabilities. And particularly when we talk about cash management, it is about all cash inflows and outflows. And marketable securities management, mostly they are cash equivalents. So they are managing short-term investment portfolios. And when we talk about accounts receivable management, we will talk about all the cash receivables. And inventory management, it is about maintaining the stock of items at desired levels of raw materials, work in progress, and finished products. But when we manage the working capital effectively and efficiently, that means the goal of that, how can we measure that efficiency, is from the goal that is to reduce both the operating cycle and cash cycle. What is mean by operating cycle? Operating cycle can be calculated from days of inventory on hand plus receivables collection period, because it refers to the time it takes a company to buy goods, sell them, and receive cash from the sale of said goods. So, cash is going outflow to buy the goods, becoming inventory, and that is sold. Maybe part of it for cash sales, but major part will be on accounts receivable, and that will be collected, that comes rotated again as cash, and then again. So this is the cycle, operating cycle, from where the business is earning profit. So that is the operating cycle. So the length of the operating cycle is dependent upon the industry. Each industry, so depends on the credit term and so many things that we will be studying in detail in the next portion when we study about cash management. And the cash conversion cycle, which is called cash cycle, is also one of the aspects that it is be measuring the efficiency of the working capital management, and it is derived from the operating cycle minus the accounts payable payment cycle, because the inventory is converted into sales, and that is coming as accounts receivable, and then from the accounts receivable is going as a cash which is paid to accounts payable. So that rotation is going on. So it expresses, this cash cycle express how many days it takes a company to convert cash into inventory and then back into cash via the sales process. So that is the thing. So the operating cycle and cash cycle is bringing, the rotation of the cash into the working capital, and account payment cycle is taking the cash out to the paying of the accounts payable. So effective and efficient management is that how quickly or how good you are rotating the operating cycle, and how are you able to delay the payment cycle, account payable payment cycle. So in that way, it is your efficiency of working capital management can lie. So here we discuss about the meaning of working capital management. When we talk about working capital, Generally, it refers to a firm's investment in its current assets accounts. But then technically we will know that net working capital means current assets minus current liabilities. But the gross working capital, we talk about total current assets. It is also referred as current capital. So actually, the net working capital provides a measure of immediate liquidity a firm has available to sustain and build its business. So therefore, it is very important how do we manage the working capital. For instance, if we have all the working capital, all the current assets are like cash or cash equivalent, so that immediately we can get it liquidated, so that all current debt obligations can be met immediately, reputation will be good and everything is good. But that is one side of the thing. The other side of thing is that we will have idle cash keeping without any effective profitable use on that cash. Like we have a lot of financing aspects also there. Maybe the opportunity cost of keeping that cash idle until for the purpose of like meeting the short-term debt obligations, maybe it is costly also. So therefore we need to invest also certain things. Maybe investing that in the uh, in order to keep, when we talk about inventory management, we will get to know that how much at what level that we need to maintain the inventory level, and that also there. And maybe we need to invest certain portions in the account receivable, like improving the credit terms, so that we can attract so many customers and your profitability can be increasing. So all these things should be balanced. So that is the important part of this net working capital management. But we will discuss individually about how do we do the cash management as a separate lecture, and how do we do accounts receivable management, and how do we do inventory management. All these things we will be discussing, including even marketable securities. We will discuss with that by in order to understand the nature of each kind of marketable securities and how do we manage on that, in order to what are the returns and risk involved on that. So working capital and its components, therefore, we should understand that cash, marketable securities, accounts receivable and inventories, and also there is prepaid expenses, also part of the current assets. Though prepaid expenses usually are already paid out expenses, and but it will be forming of the, because the work is still to be completed, so that is be the nature of the current assets part. So the gross working capital, as we saw, is the total current assets, and net working capital is current assets minus current liabilities. When we talk about net working capital, it can bring positive means or negative means. If positive means, normally it is healthy, good, and negative means that it will be, there may be a liquidity issues that we have to see in detail. It depends on the business nature, circumstances, and your other operating cycle, cash cycle, etc. And short-term financial forecast in the management of working capital is very important. So we need to forecast and do effective and efficient working capital management. So that financial forecast is very important. So monitoring a company's assets and liabilities are the primary goal in the working capital management in order to maintain sufficient cash flow and to meet its short-term operating costs and short-term debt obligations. Short-term debt obligations can come like even from the short-term debt, as well as even the presently maturing long-term debts also will fall under short-term debt obligation. So we'll have to pay maybe a long-term debt which is maturing in the near future. So that is falling as short-term debt obligation. Working capital finance concerns the optimal level of the working capital and the mix of the current assets and use of current assets and the means used to acquire them, notably current liabilities. So these are all the primary aspects of the working capital management, working capital finance management. The objective is to minimize the cost of maintaining liquidity, that is money in the bank, while guarding against the possibility of technical insolvency. So that is important, that how good we are at getting the cash in order to meet the debt obligation in time. Working capital management involves tracking various ratios including working capital ratio, collection ratio, inventory ratio for the purpose of effective and efficient management of the working capital. Actually, when we talk about working capital ratio, it is equal to current assets divided by current liabilities. It shows the firm's ability to meet its short-term financial obligations, the liquidity aspects of that. Measures short-term solvency of the firm. Working capital ratio, or it can be called as current ratio, below 1.0, that means equal current assets equal current liabilities, it becomes 1. So below 1 means that current liabilities will be more than the current assets. So it is generally indicate that a company is having trouble meeting its short-term obligations. Working capital management can improve a company's cash flow management and earnings quality through efficient use of its resources. What is the collection ratio? Collection ratio is given by the average accounts receivable. You know, how do we calculate average accounts receivable? Opening average accounts receivable plus closing average accounts receivable during the accounting period divided by 2. So that is the normal, unless if the question is given, so we can calculate this way. And that is multiplied by days in account period, that accounts receivable, or how many days in the accounting period, that means the collection period, and divided by net credit sales during the accounting period. So that's how the collection ratio, I mean how good that we are collecting the accounts receivable, the net credit sales is being collected. That is the idea. The collection ratio calculates and it provides the average number of days it takes a company to receive payment after a sales transaction on credit, after a credit sales. If a company's billing department is effective at collection attempts and customers pay their bills on time, the collection ratio will be lower because not too many days will be in wait. The lower a company's collection ratio, the more quickly it turns receivables into cash. So the students should understand, when we say more quickly, doesn't mean that more number of days. It should be the lower number of days in the calculation. Within, that means quicker the number of days, that will be quicker actually the collection also. The third important ratio for measuring the effective working capital management involves the inventory ratio, that is given by cost of goods sold divided by average inventory. Again, average inventory also can be calculated from opening inventory plus closing inventory divided by 2. It reveals how rapidly inventory is used in sales and replaced. So a relatively low inventory ratio compared to industry peers indicates a risk that inventory levels are excessively high, while a relatively high ratio may indicate inadequate inventory levels. So maybe quicker the inventory is gone, maybe sometimes that stock out situations are there, so customers are returning without products are available. So that is also a situation that you have to be carefully revealed, whether the cash flow is matching that, whether you have profitability, all these things you have to see, and you have to see the sales track record also, how many things, how many shortages, how many times the stock out situations arrive, and all these things. But this we will study in detail when we discuss about the inventory management as a separate lecture for this purpose. Components of working capital management, as we have already seen, from a financial analyst perspective, working capital equals current assets, that we know that. But from the accounting perspective, net working capital equals current assets minus current liability. and we know the goals to reduce both the operating cycle and cash cycle. Hence, we have to analyze the all the current assets part and some parts of the or as main components of the working capital. So like working capital management, cash management, marketing securities management, accounts receivable management, inventory management, and also the prepaid expenses. But prepaid expenses is not a major issue that we manage it as a separate discussion, that we understand that it is also part of the current assets. So what should be the policy for effective and efficient working capital management with some risk attitude? We know, we have seen already what can be our risk attitude also. A firm that adopts a conservative working capital policy seeks to minimize liquidity risk by increasing working capital. The most important risk involved in the working capital is the liquidity risk and also default risk. This is reflected in a higher current ratio, that means current assets plus divided by current liabilities, and asset test ratio, it's called quick assets divided by current liabilities. You know, when we want to calculate quick assets, we remove the inventory part from the current assets, so we get the quick assets, and to see the current liabilities, how quickly we can get that liquidity, that cash flow in that, even if the stock is not sold. So the result is that it foregoes the potentially higher returns available from using the additional working capital to acquire long-term assets. An aggressive policy involves reducing liquidity and accepting a higher risk of short-term cash flow problems in an effort to increase profitability. This is reflected in a lower current ratio and asset test ratio. When you have lower current ratio, that means we are having an aggressive policy in order to get better return by even financing that. So we accept that increase risk also, because we accept that way, that in our aggressive attitude we also get some increased profitability also. There is a cash flow problem, but still it is, we forego that things, and we want to take that challenge, and in order to increase the profitability. So from the cash and marketable securities, account receivables and inventory, they are the working capital's main components. How do we effectively manage using our risk attitude and gaining the return, or maybe leveraging those things in order to have a financial gain? So that is important in the working capital management based on the policy, because each company and each management may have different attitude, company may have different environment, so that you have to be there. And maybe some companies industrial products, industrial items, and some of them are seasonal items, so depends on that. Market situations are also there. All these things you have to keep in mind. So strategy for managing current assets is also a policy direction. So working capital management refers to decisions made about a firm's current assets and the financing needed to support those assets. So we have already seen the goal has to be for operating cycle, that has to be reduced, and the cash cycle, that has to be reduced. So it depends on the current assets financing policy and how it is affected by the risk, whether we are having aggressive policy or conservative policy or moderate risk. The short-term credit and working capital cost management also playing an important role. We need to analyze and assess the cost of each, the working capital cost, individual items. So for example, types of short-term credit items, it has got trade credit, short-term bank loans, commercial paper, lines of credit, and bankers acceptance. All these things we will study in detail in the following lecture. And also we need to calculate the annual interest rate of your bank loan. If we do with compensating balance requirement and or a commitment fee paid, what will be the cost of that interest? I mean cost of that uh, lending, the debt. So that is important. This all will be calculating in the cash management as well as marketable management, accounts receivable management in all aspects. Whatever this cash flow involved, so we will see that cost of that capital portion. And we have other possibilities like factoring accounts receivables and calculation of cost of factoring and maturity matching or hedging approach to financing. This all we have a detailed lecture on these things. Let's briefly analyze to see what if our policy is in a different risk attitude and what will be the liquidity level and how about the insolvency risk and what are the impact on its returns. For example, if the policy is conservative policy, a company that adopts a conservative working capital policy seeks to minimize liquidity risk by increasing the amount of working capital that it holds. As a result, the company gives up the potentially higher returns because if you are keeping conservative policy and working capital has to be more, so you will be holding cash which could return better in an opportunity investment. But we gives up that potentially higher returns available from using this additional working capital to acquire long-term assets. But it is in a safer position with respect to liquidity and possible insolvency because of the greater amount of working capital. And if we have aggressive working capital policy, it reduces the amount of working capital because we are aggressive. It becomes the liquidity level becomes low and the insolvency is high and impact on returns is positive. So there will be little higher return than these things. So the current it reduces the amount of working capital and the current ratio and accepts a higher risk of short-term cash flow problems in exchange for a greater return on investment. A company with an aggressive policy will have a very low or possibly even negative level of working capital, but will also have a higher amount of return on its assets. Totally, if it is negative, they are willing to accept a negative working capital. That means always keeping that the current liability portions are higher than the current assets. So it is also possible in short term, but in this case the company is planning to collect additional cash or receive a new source of financing before its current liabilities become due. Whenever there is a current liabilities become due, so they need to get immediate new source of financing in order to meet that, because they don't have already existing cash flow in the current assets, which is already short than the current liabilities. So they have to do that thing. In such case, the liquidity level will be very low, and therefore the insolvency risk is very high, and but return will be positive. Carrying excessive current assets such as inventory have more and can actually cost a company money, because if you want to keep stock more and if you want to keep cash idle and if you want to keep more cash equivalent securities even at a low rate of return, and it can cost a company money. The carrying cost of inventory usually increase in proportion to the quantity of inventory carried. So the more we carry, the carrying cost of inventory will be also more. Thus, the firm with excessive inventory has not only the opportunity cost of funds, because alternative usage of that funds which are blocked in the inventory will be better, but must also pay more to store and insure those inventories. So there is a carrying cost also involved on that. Not only the carrying cost of the cost involved, but also the storage cost involved and insurance cost involved on that. Also spoilage and obsolescence costs increase as inventories increase too much, or that having that kind of. The optimum level of current assets varies depending upon the industry in which a company operates. What could be the optimum level? It depends on the industry. For example, a grocery store has spoilage inventory and thus cannot carry more than a few days worth of sales at any point in time. Also, like even for a vegetable shop, it is the same situation. Also, the grocery has no receivables because it is a small petty shop like this thing. They will not have a credit terms. It will be always cash. So, it can also operate with less cash reserves than companies in many industries because it has regular sales from one week to the next. So they can have regular sales, therefore they can operate also with less cash reserve because they are having daily sales in cash flow which can be met for any short-term debt obligations. Alternatively, a kind of industrial thing, a uranium mine needs to have a high level of cash to meet ongoing expenses because its sales may be irregular. Basically, working capital policy applies to short-term decisions, while capital structure finance deals with long-term decisions. Working capital ratios are only meaningful when viewed in terms of norms and trends. In other words, an individual company's ratios are only meaningful when compared to normal or average ratios from competitors or based on industry averages. So, if you don't have anything, any benchmark, any measurement from the industry point of view or even competitors' point of view, so it is rarely going to help you. Just by having the figures only, you cannot take a decision on that. Okay, what is that percentage? You know that, but whether it is good or bad, how do you know that? You have to be a comparative analysis. So benchmarks have evolved concerning ratios, such as many lenders want to see a current ratio of 2.0 or better. That is 2 times of the current liabilities. Current assets will be 2 times of the current liabilities. However, these benchmarks often vary by industry to industry. That is also you have to keep in mind. Actually, working capital can be categorized by types like gross working capital, which we saw already. Mainly, they are the total current assets, and then net working capital, that is current assets minus current liabilities, and there is a part of permanent working capital. It is a concept reflecting the observation that a firm always maintains a minimum level of current assets. The temporary working capital is again, if you take the net working capital minus the permanent working capital, that portion is called the temporary working capital. However, it fluctuates seasonally. Hence, permanent working capital is akin to the firm's fixed assets and should increase as the firm grows. It differs in that the items included in working capital turnover relatively rapidly, although their minimum total is maintained or increased over the long term. That means the permanent working capital refers to the level of current assets that have to be maintained and are important for the firm to run its business regardless of the level of operations. Whereas temporary working capital refers to the working capital which is over and above the permanent working capital. Actually, the working capital required fund are managed through short-term credit. So short-term credit and working capital cost management is important consideration that we need to, the management accountant has to do that. So while we do that, the basic point that we should understand is that current asset financing policy and how it is affected by risk and what are the returns. Whether the company have aggressive risk attitude or conservative risk attitude or moderate risk attitude, because this table will involve based on the policy only. We understand that policy like conservative policy, aggressive policy, negative policy, what will be the impact on the liquidity level and what will be the insolvency risk level and what will be the impact on the returns. And types of short-term credit items that we know from the market is that there can be possibilities of trade credit or short-term bank loans or commercial paper, lines of credit and bankers acceptance. And each type can have a different rate of interest, different rate of working capital cost involved on that. So we should study these items also, and what is the level of risk involved, and what is the level of freedom of control on our working capital management is available, what are the conditions put forth by these credit terms also are playing vital role in decision making, and accordingly we need to calculate the working capital cost management also. And estimation of annual cost and every effective annual interest rate of not taking a cash discount is also an important point. For example, if we have on trade purchase, there may be possibilities of cash discount if we pay immediately. That can be funded by immediately taking a short-term credit and fund it, so that taking the cash discount and purchase it. Or straight away, if the cost is more, so we can straight away take the uh, trade credit policy. We will just avoid the cash discount, still take that credit as per the supplier's credit terms. And also calculating the annual interest rate of your bank loan also. And bank loan can be a simple loan, it will be there. A balloon payment can be there also. After interest payment, finally there will be a balloon payment, and there is also, and the bank will insist that we need to maintain a compensating balance required to be maintained in the accounts, a minimum balance amount. Or there may be, and or they may charge a commitment fee also. So what is the effect on these things is that the actual interest, the cost of interest will be more than the rate of interest that the bank is charging, because the actual fund that we take from the loan will not be useful, because we have to, some portion we have to maintain in a compensating balance. So the actual interest, cost of that lending, the debt will be more than the interest rate. And there are factoring accounts. How do we factoring accounts receivables, and calculation of cost of factoring, and maturity matching or hedging approach to financing, and factors involved in managing the cost of working capital. All these things we will also study in when we study in detail about the accounts receivable portions also there, and marketable securities portion to talk about the hedging approach to financing. So, determining the appropriate level of net working capital for a firm, it requires one of the following choice. A. Changing the capital structure and dividend policy of the firm. B. Maintaining short-term debt at the lowest possible level, because it is generally more expensive than long-term debt. And C. Offsetting the benefit of non-current assets against the past probability of technical insolvency. And D. Maintaining a high proportion of liquid assets to total assets in order to maximize the return of total investments. The answer is, the best option is C. Actually, the process of working capital management is the balancing of the benefits of having non-current assets against the risk of not having enough current assets. What does that mean? See, the more that we are getting some benefit, derived benefit from non-current assets, which are naturally not current assets, they are non-current assets, long-term nature, and if we have some cash flow incoming in order to meet the short-term debts, so that we can take benefit of that and maintain that liquidity problems and solvency issues, that is much better for the appropriate level of net working capital for a firm. So that's why option C is the best choice. And why A, B, D are not correct choice? Because changing the capital structure and dividend policy of the firm is not talking about the current assets, that is the working capital part. Because working capital part involves only current assets and current liabilities, whereas the capital structure is talking about the long-term liabilities. So option A is not the right choice for this question. And D, maintaining short-term debt at the lowest possible level, because it is generally more expensive than long-term debt. No, it is also not correct, because short-term debt is not more expensive than the long-term debt. So this answer is also a not correct one. And C is correct, we saw already. And D, maintaining a high proportion of liquid assets to total assets in order to maximize the return of total investment. So when that is, we studied already, when we have the high hold of cash or cash equivalent, as if that we are maintaining a high proportion of liquid assets, that means we are not utilizing the potential, the opportunity cost of that will be heavy. So that is also D, option D also not right choice. So therefore choice C is correct. Another question, a firm is considering a plant expansion that will increase its sales and net income. So plant expansion, of course, it will increase its sales and net income. So the following data is given from the current portion, current assets, and what is the current assets as well as the non-current assets, the current figures of that balance sheet, and also the management's plan, the proposed figures are also given here. This is the proposed figure. So having both current and as well as the proposed, so what we need to calculate is the effect of the plant expansion on the firm's net working capital will be whether it is a decrease or increase, and at what amount is need to be calculated. So how do we calculate that things? So the answer, in order to give that effective answer, what we need to find is the net, the effect of the plant expansion. For that purpose, we need to calculate the net working capital. So the net working capital, which will be whether decreasing or increasing, is the question. So we need to calculate from the current as well as the proposal the net working capital. So to calculate the net working capital, the current assets minus current liabilities. So it will be cash plus the accounts receivable plus the inventory plus the marketable securities, and the mortgage payable will be minus as part of the current liability, and the accounts payable also the minus. So both become the net working capital, bringing to $555,000. And fixed assets is the long-term nature, so we ignore that things. And from the proposed area also, we ignore the fixed assets part. From the remaining part, we calculate, we get $525,000 as the net working capital. Therefore, it is decreasing by $30,000. So option B is the correct choice. Third question, during the year, Mason Company's current assets increased by $120 and current liabilities decreased by 50, and net working capital, it's very simple calculation. This question is very easy one, and those who are good at mathematics can also see that mathematically put that the new working capital is asset plus $120 minus the liability. From there it is reduced, $50 is reduced, so minus $50, and this is the changed working capital. From there we have to minus the old working capital, which is asset minus liability. So if we expand this, A plus $120 minus that liability value L plus 50 minus this one will come, minus into minus become plus, so it becomes the net difference is $170, which is positive and increase. So that is the thing. So in a simple understanding, this is best done by creating a simple example. Let us assume that now the company has current assets of $150 and current liabilities of 75, whatever figure we can have it. This gives it a working capital level of 75, the difference. If the current assets increase by 120, so it will become, they will become 150 plus 120, which will be 270. And if the current liabilities decrease by 50, so earlier it was 75, now 50 decrease, so it becomes 25. So the difference of 270 minus that 25 become the changed working capital 245. So if we take the old working capital and current working capital, the difference is increased by 170. So that is the different way. So a firm has current assets of 300,000 and current liabilities of $200,000. It could increase its net working capital. How do they increase the net working capital? We should understand that net working capital can be increased by increasing the current assets or decreasing the current liabilities. So let's see these examples. By paying 50,000 of accounts payable, so that means we are reducing the current liability. And not only that, by paying means because of this payment, we are also reducing the current assets also. That is one. And option choice B says refinancing of $50,000 of short-term debt with long-term debt. So there is a current liability. We are refinancing, we are giving back that from the long-term debt by taking a long-term debt. So current liability is not increased, but long-term liability only increased. And option C, purchase of $50,000 of temporary investment for cash. This is also, we take the temporary investment because it's just a replacement from cash to another. That's also not the correct thing. And D, collection of $50,000 of accounts receivable. This is also switching from within the current assets from one aspect to another aspect, one packet to another packet, accounts receivable to cash. So that is so the best answer is choice. So refinancing of $50,000 of short-term debt with long-term debt is the right choice for increasing the net working capital among the given choices. Only the transaction that involves the elimination of a current liability by replacing it with a long-term liability will change the level of working capital. Or by other way, that current assets has to be increased. The other choices will not change the level of working capital. So next question, the balance sheet of a company XYZ as of 31st December 2020 is shown below. Assets and liabilities. So what was the company's net working capital? It's simple, we need to identify the current assets portion and current liabilities portion and calculate the working. So if we do that, so we easily get that the current assets become $585, which are highlighted in a different color, the current assets, and current liabilities also highlighted because other areas are fixed assets. Property, plant, equipment, intangible assets are fixed, so we should not include. And long-term debt, stockholders' equity are not calculated in current liabilities. Therefore, we get the working capital $65. Thank you. Praise be to God. Ella Podum Irevanukke.